what is the difference between raising from equity or raising from tokens, right? And that, I think, goes without saying. What's the difference between a SAFE with a token warrant and a SAFT? Why don't you guys talk about that?
That's a great question. Given that we represent about 50% of our work in the space is representing crypto VC funds in this space, we typically see how they view startups as potential targets for a seed round investment. And the predominant vehicle is by means of a SAFE and a token warrant versus a SAFT. This has really come together over the past 5 to 7 years. And the reason for it is SEC regulations and CFTC regulations regarding the nature of the token. Previously, under US law, we were treating all tokens as securities by default in order to comply with regulations that did not specifically address blockchain digital assets. The SAFE is a now traditional Silicon Valley vehicle for receiving seed round funding. It provides an investor with the right at the future to convert that simple agreement for future equity into preferred shares in a priced round, such as a Series A, in the future of the company. When you enter into a SAFE with your investor, they do not go onto your cap table, they do not own the equity outright, they do not have voting, and they are not part of your stockholder or shareholders agreement. They merely have the right to convert in your priced round. Some companies never get to a priced round. If they're barreling towards a TGE, that is their exit, and those SAFEs never convert. Since crypto VC funds are looking for Web3 tokens in order to build out their portfolio, they combine that SAFE with a token warrant. The token warrant is a right to receive some portion of the TGE tokens at launch. In some cases, those rights extend to subsequent launches post-TGE as well. Their tax basis for the token warrant is nominal, $500, $1,000. It is not the $100,000 or $500,000 equity investment that they are making under their SAFE. It is an add-on legal right to the tokens that puts them at a tax disadvantage because they have a low basis for those tokens, but gives them the right to the token and legally separates their rights in that token from the equity, so that in the event of a regulatory audit, both the startup and the investor can say, hey, auditor, hey, regulator, we made an equity investment under a SAFE, we purchased the right to a token, but that token purchase was not a securities investment, and if that token purchase did not satisfy SEC rules, it was unintentional. We tried to divest that from the SEC regulations. That's different than a SAFT. A SAFT is merely a purchase agreement that gives the investor the right to buy the token at TGE. The issue with that is under SEC rules, the SAFT itself is a security. So the SAFT round that a startup undertakes needs to comply with a seed round investment, just like the SAFE, just like any private placement for equity. SAFTs are still being used, particularly from offshore startups with sales to offshore investors. SAFTs also can be used where companies take on that regulatory risk. They understand that the SAFT itself is a security, they understand that they're selling tokens, but they want to hold out, not provide equity rights to an investor under a SAFE, keep the offering to a future token, and they make a strategic decision to take on the potential regulatory risk.
Well, I think the one thing I would add to what Alex was saying about just the dynamics of raising, like you have options. And I think one thing I see that goes wrong is not knowing, do we want to raise on equity or tokens? And then negotiating with investors who are newer to Web3 because they're not going to know. If there's no value alignment, things can go awry very quickly. So you want to understand, where does this investor or the VC fund come into the mix? How are they going to help us get our tokens out in the market, connect with partners that we want to be in the ecosystem, and actually get this token being used in the hands of many people. So the downside of a SAFT is you have limited options. You can do what's called a Reg D offering, which is accredited investors primarily. So that means the retail public, the average person, is not going to have your token to start until it becomes a non-security, which is kind of a Mercury standard right now. That's going to change soon, hopefully, but there's still going to be factors. Right now, it's about being sufficiently decentralized. So it's like, okay, when are we sufficiently decentralized? There's some guidance, but there's some gray area. So I caution startups to think about that, because how do you want to raise and how much time do you need? Because if you're like, hey, we're okay waiting, we'll raise from accredited investors in the US, that's Reg D. We'll raise from non-US investors, that's Reg S. That's the common structure for doing a token offering. So a token purchase agreement, a SAF, whatever you want to call it, there's different flavors of it. That's what I suggest. Just depends, like, do we have the demand? Like if we want to raise 50 million for a token offering and we really think we have strong and like demand for it, okay, then that makes sense. Versus sometimes you'll see Reg CF, which is crowdfunding, where you can raise up to, I think it's 5 million, that might have actually changed to a little higher threshold recently, where you can raise from the retail investors. But the downside, which is why we almost don't ever recommend Reg CF, is token distribution in the secondary market, very limited under Reg CF, in short. We're doing bite-sized, discussion today, so it's another topic for another day. I don't recommend that. You'll also see Reg A+, which is the complete opposite. You can do whatever you want, but very expensive. And we're talking like hundreds of thousands of dollars in legal fees and like a year plus waiting. Like I'd rather wait for the new guidance from the SEC and the new laws like the Clarity Act that are going through Congress now to be voted upon versus going that option.
So, I want you to talk a little bit about, dilution of equity, right? Especially because, as you guys mentioned, right, a SAFE with a token warrant is the preferred vehicle for investors to invest in seed rounds these days, and happens to be a lot of our founders are trying to raise a seed round. So, I'd love for you to take us through what dilution usually looks like.
Yeah, absolutely. And it's a hot topic. It always is. And I think, let's say you form that company, you're deciding how many shares do we create or authorize on day one. So that could be 10 million, it could be 20 million. Sometimes you'll see 100. Typically 10 to 20 is more norm. And then you issue a portion of those. So let's say you issue 5 million to the founding team. And let's say there's 3 founders and you split it roughly 1/3. You've got 5 million left over in treasury. Now that's going to be for, eventually you're going to have that option pool to get to hire team members, whether they're employees, they're contractors, it's advisors. So you have maybe 1 million to 2.5 allocated. Typical percentages are basically anywhere from 5 to 25% is for the ESOP, the employee stock option plan. The rest is for the investors and in treasury. So that's the setup. Now when you go to that pre-seed round, you go to that seed round, if you're raising on a SAFE, there's no dilution day one, because it hasn't converted yet. When it does convert, let's say at that Series A round, typical dilution for a price round is 5 to 25%. Depending on if you raise on a bunch of SAFEs, you gave different valuation caps, which I recommend don't doing that. You want to try to align them. And there are numbers on Carta, but typically, like most companies are in that $7.5 to $15 million valuation cap range. And that's not a valuation. It's just, that's what they're saying. Hey, we're raising at this number, and your valuation is very subjective early on, and we're within the norm of what the market's seeing. Because if you put a valuation cap of 30 million, well, you're setting a potential standard that may be hard to meet, and then it's setting the stage for your priced round. So if you want to be in that 10 to 15 million range, and then when it does convert for the investors, you're going to basically see 5 to 20% typically dilute from the founders. So now where you each had, say, 33% as 3 founders, maybe you go down to 25% each, or 28. I mean, that's what I tend to see. I mean, Alex, I don't know if you see anything different.
No,
as
those
they go
are the
through.
typical ranges. I was just thinking about some pitfalls that we've seen clients do with bootstrapping. You're talking about the ideal scenario. We're used to seeing clients come in with a less than ideal scenario, whether they've set up the wrong entity structure or their initial financing was done in a way that now needs to be cleaned up. For example, especially in Web3, you have folks doing startups who are already somewhat experienced in the crypto space. They may have a treasury and be willing to bootstrap their company. Not all of them are willing to just take that capital as equity. Some of the founders look at putting debt on the company, putting a priority loan on the company that then gets paid out. That's something that we've seen happen more and more in a frothy environment where the exit looks to be quite imminent and successful. It is not very well received by VC investors who will see an overhang of debt on a startup with limited experience and traction. We tend to advise founders to avoid things like convertible notes, in which they take debt, loan money to the company, and maybe have a right in a priced round, or are looking to be paid off by the seed round investors. This is headed in the wrong direction, and early stage companies with debt on them, large financial obligations, are often reorganized or obligated to handle that debt prior to their seed round coming in.
Yeah, certainly. I mean, it's really interesting, right, hearing this from a legal perspective as to, what investors would see and prefer. But by all means, if you have to bootstrap to build that initial MVP and get the tractions going, I mean, you just got to do what
Then we got to clean it up to make it as attractive to an investor down the road as possible.
Sure. Yeah, I think to echo on the same note, we've also talked to quite a few exchanges in the past, and a clean cap table to start with in fundraising rounds, as well as not having too much investor allocation or too much random allocation. That's always something else that they also emphasize on the listing side as well. So this is a super aligned and interesting thought, and love that you guys covered this.
I was just going to add note on the family and friends part where you're cleaning up. That often happens. You're getting support, like 5K checks early on that are part of the bootstrap. Like sometimes we'll put that in an SPV maybe to clean that up as one line item on the cap table versus like 15 friends. Or do we consider this a loan and we'll pay them back or give them equity in exchange for it? Like I have some founders who are worried about having those conversations, and the longer you wait, the more expensive those problems become, because as the company appreciates in value, they're going to say, well, hey, I did this and this. Shouldn't I get more stock? You're going to be like, wait a second, that's not what we talked about. But if it actually isn't papered, that is the biggest thing. Don't procrastinate, because you're setting yourself up for more expensive problems to pay for, whether cash or stock.
Exactly. That's a really good point, and I think that is probably a pitfall that a lot of founders that are bootstrapping are.